Hey Samson, this is Shreya from Samaya. Today we are going to discuss about the audit of banks. Why do normal standards on accounting or audit pronouncement could suffice for audit of banks? Why we require separate chapter or separate regulations or separate audit procedures for auditing a bank? We'll see now. Why bank audit? Banks are backbone of any economy and essential for sustainable socio-economic growth and financial stability. You know all the chaos that was happening right now with crash of SVB. Banks deals with public monies and are highly sensitive to reputation risk. And you see, not only for the reputation of the bank itself, but also for the government it is in, for the country it is in, for the sovereign uh, risk also makes into consideration for the banks too, because they involve, they engage with public money of the citizens of that sovereign. So for safe and sound banking sector, reliable financial information supported by quality bank audits is important. Why bank audit is important? They have public monies. So, and for the reputation risk and for reliable financial information supported by quality bank audits is important for such. What are the types of banks? First, we have commercial banks. Commercial banks provide number of products and services to general public and other segments of the economy. The two main functions were accepting deposits and granting advances. What are the main characteristics of a bank is to accept deposits and grant advances or give loans to the people. So this is normal commercial banks like ICICI, HDFC, etc. And RRBs. RRBs is mostly rural banks. These banks set up in rural areas to cater basic needs or financial needs of rural communities like Punjab Gramin Bank or Tripura Gramin Bank, and cooperative banks for a particular community. They function as commercial banks, but they were set up on basis of corporate principles and register under Cooperative Societies Act. Usually, they cater needs of agricultural and rural sectors like Gujarat State Cooperative Bank, etc. And the last one or recent type of bank that was introduced by RBI is payment banks. Like we have Amazon payment system and Airtel's or Paytm payment system, like cash wallets. We have like a wallet cash, right? Ola wallet cash or Uber cash wallet. These were the payment banks. There are new types of banks that are introduced by RBI that allow to accept restricted deposits. Customers can open current and savings account, even facilities of ATM or debit cards, internet banking or mobile banking. It depends upon RBI is letting you all go for all these options. Mostly mobile banking was used, mobile and internet banking was used for that. They were widely used, but not allowed to issue loans or credit cards. Yeah, obviously, we cannot take loan from Amazon. Example, Airtel's Paytm Payments Bank or Paytm Payments Bank, etc. And development banks. They provide funds for infrastructure facilities important for economic growth of the country, like IDBI and SIGBI. They're mostly infrastructure facilities like project loans, etc. And small finance banks. These were set up by RBI to make available basic financial and banking facility to unreserved and unorganized sectors, like personal loans for the farmers or MSMEs, etc. Like Mudra loans, etc. But that's actually Mudra loan is a product actually under the scheme, but a kind of such bank for small margin farmers or small and micro business units, like AU Small Finance Bank and RBI. RBI is a central bank of our country which regulates functions of banking industry. Now, how many types? Oh, type 1. Commercial banks, what do? They accept deposits and grant loans. RRBs, they were set up in where? Rural areas. Cooperative banks, they were registered under Cooperative Societies Act and cater needs of what? Agricultural and rural sectors. Payments bank. What do special keywords for the payments bank is that they cannot give loans. They cannot issue loans or credit cards, but they can avail facilities of ATM cards, debit cards. Okay, what's the difference between a debit card and credit card? Debit card is using or spending the money that you already have. Credit card is spending, it's like a normal loan. You're spending the money which you ought to pay the next month or when the bill was made. Internet banking and mobile banking, they whether the customers can open current and savings bank, yes, and they can have restricted deposits. They can accept restricted deposits, but they cannot issue loans. Example, Airtel Payments Bank and Paytm Payments Bank. Development Bank for infrastructure facilities, small finance banks, and RBIs. That's it. Commercial RRBs, cooperative payments, development, small finance, and RBI. That's it. What are the responsibilities of RBI? As being central bank for the country, what are its responsibilities? Development and supervision of banks and NBFCs, non-banking financial institutions. Determining in conjunction with central government the monetary and credit policies. Regulating the activities of commercial and other banks. Okay, RBI, what do? It develop and supervise what banks and non-banking financial institutions. It supervises banks and non-banking financial institutions. Okay, what do it do? Again, in conjunction with central government, that is RBI plus central government do monetary and credit policies. That's the second thing. What do they do? Supervise the banks and non-banking, and they do monetary and credit policies. Third thing, they regulate the activities of such banks which they supervise, commercial or other banks. Okay, what are the functions of RBI? Issuance of currency, obviously. Regulation of issuance of currency, acting as a banker for central government or state government, acting as a bank for commercial and other banks, issuance of license to new banks or branches, power to inspect any bank. Okay. In order to remember these all through a mnemonic or something, it's very hard to remember. Like if we write mnemonic as a C for something, we'll get confused whether it's a currency or commercial bank, and we tend to forget that. But try to remember as a category. RBI. For what are the functions of RBI? First thing, with regards to currency and with regards to government and with regards to banks. Currency, issuance of currency, regulation of issuance of currency, issuance of currency, regulation of issuance of currency. Second thing, acting as a banker for central government and also acting as a banker for commercial banks. It's acting as a banker. Second category. Oh, good. And we are linking that second category to third category and issue license to new banks and power to inspect any bank with regards to banks and acting as a banker and currency. Three categories is more than enough to remember like this. It's so easy to write in an exam like that. And what are the regulatory framework is that these are all the acts that one has to remember. I think mostly these won't be asked or tested in an examination because you have to write all these acts and write the year number and all. It's very cumbersome, and mostly they ask whether this is whether it was in a regulatory framework or not in an MCQ for 1 or 2 months. You could read it just one day before the examination and you're good to go. Now we'll read that. Banking Regulation Acts, State Bank of India, Companies Act. And why they were mentioning more about Companies Act and audit of banks is that banks registered under Banking Regulation Act 1949. But NBFCs, non-banking financial institutions, which register under Companies Act, is an NBFC. RBI regulates NBFC also. So that's why Companies Act was here. And because central government is having funding or being a party of a state bank, it's own State Bank, right? So State Bank Acts were there. State Bank India Subsidiary Banks Act 1959, Banking Companies Acquisition and Transfer of Undertaking Act, RRBs Act, Banking Companies Act 1980, IT Act. Why there was IT is here. Banks usually have a lot of transactions. You see, all the mobiles were there, payment QR codes, and internet banking, and so much of forex that's going on there, right? So mostly all the products in the banks that were that were introduced, were mostly of usage of IT. So they have also included the IT Act here, PMLA Act, because public money was involved, and there would be so much of frauds that might happen for conversion of black to white money, and securitization and reconstruction of Surface Act. This is normally, and Credit Information Companies Regulation Act and Payment Settlement Act. And these were for the regulatory framework. You need not remember these all. Just give it a go. That's it. RBI's power to give directions. If they find any of these or within a bank, they could give directions for that particular company, etc. If they find huge volumes and complexity of transactions, and they have wide geographical spread of the bank network, and they have wide range of products that were offered, and an extensive use of technology. See, bank. When you think of bank in examination, what you need to have in mind. The first thing is about the transaction. Second thing about the money. Third thing is about the IT technology. And with the IT technology, what you have to think is you could use it from anywhere. So the something that's linking to IT technology is about the volume of transactions plus the geographical spread. For the from You could use your bank account from anywhere in the world, right? Yes. And strict vigilance by banking regulator. So what we need to have when there was a bank in question that has to happen, what all our answer has to revolve around what all topics was about the transactions and about the geographical spread and the products it has in the technology. Strict vigilance of banking regulator. Moving on to what are the general banking audit reports that a statutory auditor has to give, apart from or in addition to his audit report. He has okay, relax. Why we went for a bank? Why we went for an audit? We went to form an opinion on the financial statement. Prior to that, we have to find out whether the internal financial controls or internal controls in that bank were or in that entity were efficient enough or not. That's also what the responsibility of management is. Okay, you have to give reports with regards to only that. If a bank is registered under Companies Act, a report on adequacy and operating effectiveness of internal controls has to be given. Yeah, a first duty. internal controls. As per 300, as per 300 cities and all, what we have to do, we have to, as an auditor, we have to check the internal control efficiency. If it's just saying that, we have to give an adequacy and operating effectiveness of internal control, first thing. And secondly, what we went for, we went to give an opinion on financial statement. So LFAR, it's mostly like a questionnaire of long form audit report. It's mostly like a questionnaire. So various aspects or various items of financial statement it's talking about. And banks were being regulated by RBI. RBI had set some SLR requirements, so the banks should follow. We have to check that. And our treasury operations as per RBI instructions. That's the fourth thing we have to do. And as there was so much of drama that's going on between standard assets, NPE, substandard assets, and all, we have to also check the Iraq and provisioning norms as per RBI. That's something that's related to bank. And report on serious irregularities which requires immediate attention. That's something, any deficiency or irregularity that's found by the auditor, we have to give a report on that. And as banks involve so much of money that was involved, we have to check what about any fraud that had happened. Ghosh committee is for the frauds, and Jilani committee is for the internal controls, compliance status, and the report on instances of adverse credit deposit ratio in rural areas. Bank had given more loans than what the deposits it has taken in rural areas. They also have to check for that. And what we have to give. First thing about internal controls, LFAR, SLR, and treasury operations, Iraq and provisioning norms, and about any serious irregularities, Ghosh committee, Jilani committee, and adverse credit deposit ratio in rural areas. And we'll move on to the next topic, understanding the bank's accounting system. Banks' use of technology providing customers anytime, anywhere banking by letting them access their information on real-time basis as stored in a safe and secured environment is obviously that's what we are doing right now. Anywhere, anytime banking and on a real-time basis. The transactions of banks have become voluminous enough, and it is need to be ensured that in the system of recording, transmission, and storage of information is optimally maintained, and control systems ensure that same is free from errors, omissions, irregularities, and frauds. As the transactions were voluminous, what we have, what the system has to implement, what the responsibilities of the management is to record, transmit, that's communicate, and then store the information to maintain a control system so it's free from what errors, omissions, or irregularities of frauds. Okay. Considering the challenges of technology, banks management continually endeavor to make their internal control system robust, safe, and secure, as well as continuous and expeditious for the customer. Okay. I think the sparrow is like for most of convenient for the customers. Like they have to make safe and secure is the keyword here, safe and secure, and they have to not miss any kind of information that is with regards to any kind of errors or omissions, irregularities or fraud, and have to put a system that records, transmits, and store all the information. And what are the bank's categories? Banks were categorized into three types of level of computerization. What is this here? These are types of banks with regards to the activities the banks perform. With regards to the computerization level, we are categorizing that non-computerized banks. Transactions are done at banks in working hours with paper and pen. That is with no computers at all. And partially computerized with some transactions were computerized and major transactions were not computerized. Okay. And fully computerized. Core banking, that's CBS. CBS is something that was opted by every bank right now. This is what most of banks were doing. Fully computerized. Core banking allows interconnectivity between branches with CBS, and customer can operate from any branch over internet. Non-computerized, partially computerized, and fully computerized. And computerized, what are the difference between computerized and non-computerized? All banking activities done by computer system under computerized, and banking system was done under manually for non-computerized. Transactions anywhere, anytime, transactions only during the working hours. And this is mostly around 30 to 40 years back kind of scenario. Banking process shortens the time. Non-computerized banks takes a lot of time to process the transactions, and computerized are more productive and non-computerized are less productive. Okay, these were just go through it once, and there's nothing to remember mostly. If you remember, there's three types of banks. It's mostly the same. And our second step is control environment at bank. A bank should have an appropriate controls to mitigate the risk. That's what the management responsibility is to they have to design, implement, and maintain the internal control system and prepare the financial statement. They're talking about the control environment at a bank should mitigate the risks of any kind of risk of misstatements, risk of material misstatements. What do they could use for mitigating the risk? Were segregation of duties of whom of the employees or the person on that, and providing limits for the management threshold limit for giving any kind of loans, etc., and reconciliation, VRS approvals, etc., and management engagement team discussions were All the personnel performing in engagement, including any experts like audit experts here, contracted by the firm in connection with engagement, are known as engagement team. Engagement team consists of who? Engagement partner, all the personnel who are performing, plus auditor experts. They should hold meetings for a better understanding of banks and its environment, including its internal control SA315, to assess the material misstatement. You see, in order to write anything for an audit, it was mostly like a process for the audit, like for something they're talking about the responsibilities or preliminary activities or something ethical requirements. You have to use mostly SQC1 and say 200 series or 200 series standards. And for performing audit, you have to see 300 series audit. For any specific things, you have 500 series, and 600 is for using the work of the others, and 700 forming an opinion. You have to see like that and write phrases from those standards so that it's easier to get more marks, and it's mostly those were only the keywords there. And what are the matters to be discussed by these engagement team? What the matters have to be discussed by the engagement team were errors which are most likely to occur. Okay, errors which have been identified in prior years. They're talking mostly about the errors they have identified, and they're more likely to be occurred due to any kind of irregularities that they have found in internal controls, etc. And the method by which fraud may be perpetrated. That is how the fraud is being perpetrated, whether through its personal or whether through any kind of inventory or false or manipulation of accounts and false fictitious entries or by management. Audit responses to engagement risk and pervasive risk and specific risk. That is auditors' responses and need to maintain professional skepticism. Okay, that they are talking about the ethics here. Need to alert for information. Professional skepticism is being alert in the audit process while throughout the audit and having a questioning mind. The same thing. There's a connection. Need to be alert for information that indicates a material misstatement. This mostly talking. Both were talking about the same thing. That giving a term here, but they were elaborating it more. And this to the audit response. After there's so much of errors that were identified or frauds they were talking about, auditor has to respond. So it's if you put it in a category wise, why the engagement, why any kind of discussion that has to be happened. We went to find errors, right? Not that's not the end goal, but to give an opinion. Why do we discuss? We discuss any kind of errors that were identified or likely to occur and fraud. How the fraud may be perpetrated. For all these errors and fraud, what do the auditor has to respond? How the auditor respond means what makes the auditor to respond is professional skepticism in nature. And what's they were just elaborating that him to being alert that indicates material misstatement. This is how, without by hearting, you live in that situation and write answers, and you could write it full and with all the keywords, and you could gain marks, maximum possible marks in audit. And what are the advantages without straining your brain much? Yeah. Now we are discussing about the advantages of such engagement team discussions. It specifically emphasizes on material misstatements that enables engagement team to consider responses to risk. That's like why there was engagement team discussion has to be done is putting an attention or emphasizing on material special focus on such material misstatement that was identified. It enables audit engagement partner to delegate work and determine procedures to be followed in case of fraud. Okay, auditor has a responsibility what to report the fraud. And partner had what if he had found an fraud, what he has to do as per the regulators, or whether he have to communicate with the PCWG or regulators, and all the procedures that has to be performed, and what putting some experts there for delegating work so that it would be fully. He could report on that. Report on that. And audit engagement partner may review the need to involve experts to address the issue relating to frauds. That's what we have discussed. Special focus on material misstatements, and auditor delegates the work and determine the procedure that have to be followed. And it's also review the need of the experts, the auditor experts to address the frauds. You see, we cannot find out any kind of fraud that had happened in any electricity industry. We are not trained for that. But there was a few experts who were very efficient in electricity industry, or like telephone industry or energy industry, gas, petroleum industries, so that we use those experts in order to report such frauds. There were so much of science that was going on there. And the financial statements of banks, in what form and content the financial statements have to be given by banks. Form A, balance sheet. Form B, P&L account of the third schedule of Banking Regulation Act 1949. Form A, balance sheet. Form B, P&L account. If you have get confused, Form A, balance sheet consists of two A's, right? Form A, balance sheet. Form B, profit and loss account. Form B and balance sheet both starts with B, and get it. This is also a trick to remember. That's it. You cannot, there was no logic behind this. This is just a fact memorization. So we have to use all these tricks to remember these in order not to write wrong in examination. And authority appointing the auditor. First, for a banking company and a nationalized bank, there were who has to make a prior approval is that RBI, because RBI regulates mostly all banks. For banking company, it's AGM, and for nationalized bank, it's a board of directors. And for the prior approval of central government, obviously we know that SBI had got a central government has got a stake in SBI. So C&AG, like, it's mostly like a government company, and for RBI, the concerned bank. And that's it. And who decides the remuneration for a banking company? AGM decides. Why? For a banking company, company consists of shareholders, right? So that's why they're talking mostly about AGM shareholders, etc. For a nationalized bank, it's not a company. It's not registered under Companies Act, and so it's a board of directors they were talking about. And nationalized bank or SBI or the others, RBI in consultation with central government. Okay. And our next topic is auditor's report. Nationalized bank or SBI, the auditor has to give report to central government. Why he has to give to central government? Because for the appointment, they have taken who appoints auditor under SEBI, C&AG, right? For nationalized bank, it was board of directors, though also it has to report to central government. Whom we report is that who appoints us, right? To whom we report, who appoints us, we report to them. So when it's his opinion, financial statements are true and fair view, explanations are satisfactory, whether or not the transactions of bank have come to his notice are within powers, whether or not the returns received by bank are adequate for the purpose of audit or any other matter that brought to CG notice. What he has to report? He has to report four things. His opinion on financial statements, okay. And about when we think of banks, what comes into our mind? Transactions. Whether transactions were within powers or not. Okay. Whether the returns received bank were adequate for the purpose of audit. Sufficient and appropriate audit evidence or any other matter, they should be brought to CG notice, like any irregularities. LFIR is submitted before 30th June every year. LFIR does not require an executive summary but may consider providing to bring up key observations from the whole document. Okay. With regards to LFIR, we have to remember 2 points. LFIR is have to be submitted before 30th June every year, and it need not have an executive summary but provide key observations. That's it. 30th June, no executive summary but key observations. And as we've been discussing lately, that auditor has some responsibilities to report to higher authorities with regard if you found a fraud. Now we'll see what all the responsibility of the auditor were. Fraud reporting. Fraud involving less than 1 CR. Fraud involving 1 CR or more. That is, this is 99 lakhs up to 99 lakhs and 1 lakh. If it's less than 1 lakh, report to board or audit committee within 2 days of his knowledge. That is when he found when that fraud had come into his knowledge. Within 2 days, he has to report to the board. And if that company doesn't have an audit committee, if it has audit committee, he has to report to audit committee. Report what he has to report about the description, nature of fraud with description and appropriate amount involved and the parties involved. What he has to report about the nature and description of the fraud and the amount involved and parties involved. Okay. And discloses in board's report disclosures of the following about the same, the nature of the fraud with description and the amount of parties involved, the amount involved and the parties involved, and the remedial actions that have been taken. As the auditor had reported to the board or communicated to the board, what the board has to do, board has to give its responses. That is what we call as management responses or remedial actions. So in board report also, the board has to mention about the fraud. And the fraud involving 1 CR or more, what the auditor has to do. The auditor has to report to central government in the following manner. Here in audit of banks, auditor has to communicate only with the central government. Here also we have seen, right, whether the auditor has to give report to central government with regards to these four, like opinion on financial statements, transactions, information, or other matters, right, audit evidence within 2 days. Whether it's less than 1 CR or 1 CR or more, it's within 2 days. Have to report to whom? Board or audit committee. This portion, 2 days, and board or audit committee is the same. And he has to seek reply within 45 days. That is, the board or the management has to give the reply within 45 days, and the auditor has to observe those audit observations, reply to the observations or remedial actions that were taken, and forward that report and the reply for the observations and comments to CG. That is, he has to report what he has given to board. Second thing, he has to also give the management responses, and he has to give his own comments on the management responses. He has to give three within 15 days of receipt of such observations or reply from the management. Here, this is what he has to communicate with central government. And if he had not given any reply from the board, what he has to do? He has to forward the report, a note containing that they have failed to reply to CG and his observations to CG. Whether it's less than once a year or more than once a year, he has to do what? Within 2 days, report to board or audit committee. What? The nature, description, amount, and parties. And if it's less than 1 lakh, he need not communicate or report to central government. The remedial actions were mentioned in board's report. That's fine. If it's more than once a year, this 45 days and 15 days comes into existence to communicate or report to the central government. That's it. Now we are moving on to the next topic, bank audit process. Firstly, what are all the initial considerations that have to be taken by the statutory auditors? As we have already discussed, when there was an initial consideration, that is prior to start of or prior to audit, what are all the things that have to be done by auditor was discussed in 200 series. With regards to preliminary activities and all, we'll see one by one. Declaration of indebtedness, that is eligibility of the auditor that you see in the company audit, similar. Situation of, it's a situation where the auditor should not owe to the bank, that is, the auditor should not take loans from the bank. That's the assignments in the bank by statutory auditors. RBI decided that the internal auditors cannot be statutory auditors. You see, internal auditors mostly like employees of the company or employees of the bank, and statutory auditors were some separate independent agency or independent party. So they cannot, both cannot be the same. And planning of the audit as per SA 300 cities, you have to plan the audit as per SA 300. Auditor has to perform audit with regards to standards of auditing, and they have to communicate with previous auditor SQC1 or 200 series, and professional ethics clause 8 part 1 of the schedule, and the terms of audit engagement as per SA 210, and initial engagements as per SA 510. Whenever it's an initial engagement, what all he has to check, and assessment of engagement risk, and establishment of engagement team, and understanding the banks and its environment as per SA 315. This is they're talking mostly about the generic point of view. If you write through 4 to 5 points with regards to that, it's more than enough. Mostly with regards to 200 SQC1 requirements, etc. And the second thing is identifying and assessing the risk of material misstatement. This was the duty of the auditor while planning the audit plan, while doing an overall audit strategy, and understanding the bank and its environment, including its internal control system, that is as per SA 315. Understanding bank's accounting process, that's what we have discussed above here. Bank's accounting process, yes, here. Why? Because we also have to check the internal control system, right? And understanding the risk management process. Yeah. Why we have to check or understand the risk management process is that whether the management was putting some remedial actions or to mitigate the risk of what? A risk of material misstatement, whether a risk of any fraud or irregularity is happening. And the oversight, how do we have to understand the oversight and involvement in control process of TCWG, identification, measurement, and monitoring of risk, control activities, monitoring activities, and reliable information system. He has to check whether the TCWG is oversighting and involving the control process, whether they have established and they were supervising or reviewing the control process. We have to check that. And identification and measurement and monitoring of this, we have to identify what the risk and measure the impact on the financial statement and monitor that. And all the control activities were the internal controls, and monitoring activities is what the activities that are done by the higher level authorities like management or TCWG with regards to the internal controls. Monitoring internal controls, we have to check the internal activities, control activities, and monitoring the internal controls and reliable information system, that is the bank's accounting process, that is whether everything was accurate, all the calculations were complete on it. And the sixth one is engagement team discussions. We have already discussed that. Or you could write that and establish overall audit strategy as per SA 300. You could write from SA 300 also from there. After establishing the overall audit strategy, what we have to do? We have to develop audit plan. And an audit plan. And after audit plan, we have to do an audit planning memorandum. What is an audit plan memorandum? It is actually a summary of audit plan that describe the expected scope and extent of audit procedures to be performed by the auditor. It is mostly like a to-do list for the article extent or the personnel that were given by the auditor. Highlight all the significant issues and risks that were identified is obviously provided. Provide evidence for appropriate audit engagement plan and have respond to engagement risk, persuasive risk, and specific risk. These were the benefits of the C pointers, or mostly talking about the benefits of audit planning memorandum that it creates an evidence for that the engagement has been appropriately performed or not, and they respond to the engagement risk, persuasive risk, and specific risk. First thing, it has to describe the scope and other processes, and second thing, it has to highlight the significant issues. Third thing, it's benefits and provide evidence for the engagement plan and the responses to such risk. And the 10th one is the determination of audit materiality. You see, I say don't go and ask to write all those points one by one. You need not remember all this. This is something that it might be tested in individual point of view. What we are doing is that we are not learning something special from this. We are just linking to already what we have learned in our audit standards. As for if you observe this is all what we have learned. This is what we are just revising it in a certain format. That's it. You need not remember everything except this understand the risk management policies and definition of audit planning memorandum. You need not remember or memorize anything. This is you have to make a note that you have to understand what all the things have to be written when what the topics were asked, when what topics were asked, what are the things you have to be written, and determine the audit materiality. Audit materiality. The auditor should consider the relationship between audit materiality and audit risk. Determining audit materiality is a matter of professional judgment and depends upon the knowledge of the bank. That's it. Audit materiality is like a specific threshold limit where if after checking the preliminary activities and identifying and assessing the risk of material misstatement, auditor by usage of his professional judgment sets up some audit materiality like some percentage on profit or some percentage on expenses or a predefined percentage on sales, etc. He has to check the relationship between them and consider going concern and assess the risk of fraud, including money laundering, and assess the risk of specific risk and risk associated with outsourcing and response to assessed risk. After all the risks that have happened, the auditor, what he has to do, he has to respond to that risk. And they're talking about Basel III framework. Basel norms or records are international banking regulations issued by BCBS, that is the Basel Committee on Banking Supervision, and Financial Stability Board has taken an extensive review of regulatory framework. This global regulatory framework, released in December 2010, which proposed a minimum set of criteria for inclusion of instruments in regulatory capital. It focused on risk to bank and financial system called Basel Accord. This is mostly our definition. I'll read it once, and you need not. It's better to know the elaboration of this BCBS and etc. Know the context of what it is. So it might be tested in an MCQ. You don't need not write all these 4 or 5 lines. It was never tested like that. Write a short note on Basel III framework. Likewise, it is mostly like whether you know the concept or not. This is only for that to know the full forms, etc. It could be asked for 1 or 2 marks in your examination, and go through it one day before the examination and review for other reports. The auditor should consider the adverse comments in what all the auditor has to read the reports. What reports he has to read? The auditor should consider the adverse comments in what? Previous year audit reports. Yes. Latest internal inspection reports of bank officials, that is head office, if you're doing it for a branch, the head office reports, etc. And Reserve Bank's latest inspection report is, or we also do supervise the bank activities, so it also gives report. First thing, last year auditor, previous year audit report. Second thing, bank's higher authority, that is bank's internal inspection reports. Third thing is the RBI's latest inspection report. Fourth one is concurrent or internal audit report, okay, and report on verification of securities. Any other internal reports, manager's charge handling reports when incumbent is changed. These were all the reports that they were talking about. Now we will discuss about the advances. Advances are amount of money or credit given as loan by a bank to another party with an agreement that the money will be repaid. That's what an advance. Advance is the loan that was given by the bank that it has to be repaid. What are the types of advances? Advances are funded loans, such as loans where there is an actual transfer of funds, like bank, that is funds move from bank to borrower, like term loans, cash credits, overdrafts, demand loans, bills discounted and purchased, interest-bearing staff loans, and participation on risk-sharing basis. These are all the funded loans. And non-funded facilities, they do not involve any kind of funds transfer. Actually, bank, what do it do is it provides a guarantee for whom, like for exporters or for business people, like LOC or bank guarantee, etc. These are of balance sheet items. And disclosures in the balance sheet, or all the disclosures that have to be done in balance sheet were what are the bills that were purchased or discounted in the year, cash credits, overdrafts, and loans repayable on demand, that is current advances, term loans, non-current, And secured by tangible assets, these were with regards to security, and covered by bank guarantees or government guarantees, again a secured portion. And third one is unsecured one. And also category under C is first thing, advances in India for priority sectors like housing, agriculture, and public sector, that is banks, and for other banks and others. Priority public and for other banks and for others. And with advances outside India, that was giving loans to outsiders, due from banks, due from others, with regards to bills purchase or discount or syndicate loans or others. Now we'll see the classification of advances. Classification of advances with regards to sector wise. It's priority sector or non-priority sector. Priority sectors are agricultural, MSME, education, housing, etc. Non-priority sectors were others. And for security wise, whether they are secured or unsecured, primary or collateral for secured. Primary security is offered to borrower against which credit has been extended by bank. The security is principal security for an advance. The security is an additional security which could be of any form, whether it's a tangible, intangible, movable, or immovable. What we have seen sector-wise priority, non-priority, security-wise secure, unsecured. Under security, we have primary and collateral also. Primary is on what basis? Like if you are putting a house and taking a loan, that is our primary security. And we are all, if that after that, if we wanted to extend our loan, if we are putting gold, that's a collateral security. So this is with regards to the security wise, and what the modes of creation of security, like what are the types of creating security, like mortgage or pledge, hypothecation, assignment, set off, or lien. Mostly you have seen it in your foundation exam. For the mortgage, registered mortgage, there are two types of mortgage, that is registered mortgage and equitable mortgage. Mortgage is a registered mortgage when borrower signs mortgage deed or register the property to bank as a security, like land. You have to check while giving a loan, the bank has to change in favor of its name, change that security in favor of its name. And equitable mortgage is a mere delivery of title deeds with intention to create a security. That's mostly done by all the money lenders that we see here. Pledge. Under pledge, you have the possession is with the bank, but the ownership is with the borrower. Here, for the hypothecation, the ownership is with the bank, but the possession is with the borrower. Pledge, ownership is with borrower. That possession is with the bank. Hypothecation, possession is with the borrower, and ownership is with the bank. Assignment is mostly like a factoring, where you transfer your future asset for current money or selling that, and setting off is like netting off, and lien is mostly like a seizing or disposing of the assets under lien. And what are the classifications of advances as RBI under prudential norms? Like assets were categorized into two: standard loans and NPAs. Standard loans is regularized where the interest and the principal amount was paid regularly. But they were, if it is not paid more than 90 days, it's treated as an NPA. But before 90 days also, SMA 0, SMA 1, SMA 2, they were categorized into these three categories. Special mentioned accounts where accounts showing stress signals, zero stress signals, and SMA1 overdue between 31 days to 60 days, and SMA2 is overdue between 61 days to 90 days. That is 0 to 30 days SMA0, SMA1 between 31st day to till 60 days, and from 61st day to 90 days SMA2, that is special mentioned accounts. You have a red flag over there for the NPAs. And after NPAs, you have substandards. All NPAs were substandard, and doubtful assets and loss. And we are seeing categories of NPAs asset, how much provision has to be made for the substandard assets which remained as NPA for a period less than or equal to 12 months. That is 15%. You see, after becoming an NPA, it has to be up to 12 months. Up to 12 months, it's 15%. That is overdue is this 12 months plus the 90 days. That NPA time limit also was included here. Please make a note of it. That's 15%. And for doubtful assets, there were subcategories. Doubtful up to 1 year, that is up to 1 year. Secured portion 25%, and for all the unsecured, it's 100%. And doubtful assets from 1 year to 3 years, it's 40%. And doubtful for more than 3 years, it's 100%. 25, 40, 100%. And for the loss asset, where it's totally 100%, all the provision has to be, all the loss asset has to be made a provision. What are non-performing assets? Non-performing assets are loans or advances where the interest or installment of principal remain overdue for a period more than 90 days. If it's overdue for lesser than 90 days or up to 90 days, it is a special mentioned account, SMA0, SMA1, or SMA2. When account remains out of order with respect to overdraft or cash credit, and the bill remain overdue for a, this is talking about overdraft or cash credit, and for the third category, they were talking about the bills discounted. They have remained overdue for a period more than 90 days. That's always a more than 90 days concept here in NPA. Out of order. Out of order. If the outstanding balance remains continuously in excess of sanction limit or drawing power for the overdraft. That is, it's continuously in excess. Thus, they are not getting any sales that has to be credited to that. When the outstanding balance is less than the sanction limit, but there are no credits continuously for 90 days, as on the balance sheet date. That is, and the credits are not enough to cover the interest debited during the same period. First thing, overdrafts were designed in such a way that it is mostly to meet the working capital requirements. An overdraft, at least 85% of the sales has to be credited to the overdraft account. All the credit should be done. So that first of all, that they were withdrawing more than the sanction limit they had given. That's out of order. And second thing is there are no credits for 90 days continuously. That's out of order. And the credits are not enough to meet the interest debited. That's also not out of order. And overdue is not paid as due date fixed by bank. That's we know that. And accounts regularized near to the balance sheet date. Whenever you find such a word, when accounts were regularized or made standard, or board, the bank has to check whether the sources were from genuine or not. The borrower should not take a second loan in the same bank and repay that. It is like covering up the old loan with a new one. It's just like window dressing. You have to not do that. If credits are recorded before balance sheet date, they should be handled with care. If the account had inherent weakness, it should be deemed as an NPA. If it's not from a genuine source, or if the borrower had taken a loan in order to repay the old loan, you see, the borrower can take loan from other bank, but not from the same bank or different branch of the same bank. And government guaranteed advances, CG guaranteed advances, where the guarantee is not invoked invoked is classified as a standard asset but treated as NPA for the income recognition purpose. This could be mostly asked in an MCQ while twisting that central government or state government, etc. All the central government advances, when the guarantee is not invoked, is classified as a standard asset but treated as NPA for the income recognition purpose. And advances against a consortium. Consortium is a group. When a group of banks have given a loan to a particular company under a consortium, consortium is a cluster. It's a group. Two or more banks form a consortium to advance loan to a borrower. Usually, a bank with higher share will lead the consortium. That is, as a leader. These advances should be based on records of recovery of banks, whether remittance of borrower are pooled in one bank as per consortium lending arrangement, and receiving bank is not parting with the share of other member banks. The account should be treated as not serviced in the books of other members' bank, and therefore as NPA. Now, what they are saying is that they have a few banks pooled together and gave loan to a customer. Now, what the customer did, as per consortium lending arrangement, he repaid that to one bank. He repaid that. Okay. Now, the receiving bank, as per this agreement, had not parted that share with other member banks. Then, what these other members have to do, that account shall be treated as NPA under the head not serviced in the books of other member banks. And that's it. And the banks participating in consortium need to arrange to get their share of recovery transferred from lead bank or get express consent from transfer of share to ensure proper asset classification. That is, all the members who are there have to try to make some arrangements and recover that. This is who has to treat it as an NPA. The receiving bank has to treat it as an NPA under this heading. And the accounts where the erosion in value of security of frauds by borrowers. Erosion means that is a decrease in the value. Here they have what they have put some hypothecation mortgage and all that, but all the security had decreased in the value or eroded in the value. Erosion means gradual destruction or diminution. They have put a building that building due to earthquake had collapsed, or which found that there was no value for that property. Erosion in value of security can be reckoned as significant. That's a significant matter. When realizable value of security is less than 50% of the value assessed by bank, that is, its value had eroded 50% or more. Such NPAs are classified under doubtful category, no substandard and or directed doubtful category, and such provision is applicable. We know that, right? Doubtful categories: 1 year, 2 years, 3 years, 25, 40, 100%. And if such a realizable value is less than 10%, is loss asset and should be written off fully. That is more than 90%. That is more than 90% of value is destroyed. It is directly loss asset and should be written off fully. That is 100%. Advances against term deposits under any life policies or etc. Need not be treated as NPAs if there is an adequate margin. If there is an adequate margin, they need not be treated as NPAs even in the erosion in value. When agricultural advances affected by natural calamities, classifications is governed by a master circular issued by RBI. Banks may decide their own relief measures like conversion of short term to long term or reschedulement, etc. For being agriculture is a priority sector, what they are trying to say is that more relief measures like they need not categorize into doubtful category or loss system, they could reschedule the loan or some other remedial measures. And banks giving advances to its staff. Interest-bearing staff advances are included as a part of advances portfolio of the bank. Yes, they were included in advances in case of housing loan, where interest payable after recovery of principal, the interest need not be considered as overdue because the due date for the interest is only payable after the recovery of principal. So there is no due, so there cannot be an overdue. Such advances are classified as NPA when there is a default in repayment of principal or interest. Yeah, even the advances to staff can also would also be treated as NPA. And the staff advances are given as employer, not as a banker. So they are included in other asset schedule. It's the intention of the bank. If they are giving it as an employer other than a banker, then include it in other asset schedule. Agricultural advances with regards to long duration, if it's longer than 1 year, short duration, that is with regards to short term or long term. Long term is more than 1 year, short term is less than 1 year. With regards to crop season means the period up to the harvest, determined SLBC through any kind of regulations or directions given by it. Long term means it is treated as NPA if the installment of principal or interest remains overdue for one crop season. If long term duration, it has to be treated as NPA if it's overdue for one crop season. If it's short term, if the installment remains overdue for two crop seasons. Okay. And well, with regards to computation of drawing power is mostly used in overdrafts and working capital uh, loans for the hypothecation of stock. Uh, Drawing power is a limit up to which the firm can withdraw from the working capital limit that was sanctioned. Yes. Sanction limit is a total exposure that bank can take on a particular client. Though the drawing power is a part of the sanction limit, but the exposure, that is the bank's risk exposure, is to the sanction limit. This total amount that the bank had sanctioned. All drawing power and sanction limit, if they exceed or have, that is what we have seen negative, right? More than excess of that sanction limit here. Sanction limit here, where we have seen that. Oh yeah, in out of order condition. If they exceed or have granted against unapproved security, should be brought to the notice of management of it. Oh, okay. And the bank should ensure that the drawings are covered by the adequacy of current assets. That's a stock statement, and DP is required to be errored based on the current stock statements. That is not older one. For every 3 months, they have to submit that stock statements which were audited. They should not be older than 3 months. They're talking about the time of 3 months. If so, deemed irregular. Those stock statements were if they were older than 3 months, then such overdraft would be treated as irregular. And the stock irregularity, there exists some irregularity, and the stock statement or the quarterly returns, audited annual report, monthly stock statements shall be scrutinized in detail. Yes. Who has to scrutinize? As we auditors has to scrutinize. While computation of DP, special attention to sundry creditors is given with extent to guidelines formulated by board of directors agreed by the concerned statutory auditors, and the stock audit should be carried out for all accounts having funded exposure more than 5 years. If the sanction limit is more than 5 years, stock audit has to be done by banks. And why they are trying to say what sundry creditors is, they also include sundry creditors here. If you see this, there was given a picture of computation of drawing power. They include stocks plus sundry creditors and their margin for that for computation of drawing power. That's why they were stressing more on the sundry creditors. And audit of advances. First, we have to obtain evidence about what amount outstanding in balance sheet with respect to advance as on date of balance sheet. Whether as on the date of balance sheet, the amount outstanding was with regards to advances is genuine or not. How do we know that? Through third party confirmations. Advances represent amount due to bank. Okay. Advances represent amount due to bank and are supported by loan document. And there are no unrecorded advances. They're talking about the completeness in the information. And that basis of valuation of advances are appropriate and properly applied, and its recoverability recognition. That is the security that they put for taking advance the borrower. You have to take such valuations, such securities, and advances are disclosed, classified, and described described as per accounting policies and practices or statutory and regulatory requirements as per rules and regulations. Appropriate provisions towards advances. Okay, these are all the evidences that we have to take with regards to advances. What we have to take? First, we have to take balance confirmations. Balance confirmations and that they were due with the bank and that they were due with the bank plus supported by the loan documents. And were there any unrecorded advances? We have to also check that. And for that, and also what we have to check in addition is the securities, whether they have been as per policies, accounting policies, and the valuation principles were good, and all the provisions towards the advances were done as per provisioning norms as per RBI, and obtain evidence by examining validity of recorded amounts, loan documentation and their existence, enforceability and valuation, and reviewing the operations of account, carry out analytical procedures, checking the compliance of RBI. You need not remember these things. How do you have to write it in examination is go to the standards and how do you check any kind of evidence? How do you do that? Auto has to read some minutes if at all they have to take any decisions or something other than. You just live in that situation and you could write that. How do you do? First, you have to examine the account balances and securities and the operations of account, whether you have to walk through the process of that, that's operations of accounts, and carry out analytical procedures. Analytical procedures for something where you match with financial monetary elements with non-monetary elements, like something kind of stock with regards to its value. If they're showing 100 units and they're putting it as 20 lakhs, and then after 3 months they're showing as 110 and putting it as 35 lakhs, that's not something that there exists some irregularity, right? So we have to check the analytical procedure, checking the compliance of RBI norms, obviously. Internal controls over advances should include what all the internal controls we have to check for. Before making any advances, documents were executed, proper documents were executed and satisfied credit worthiness of the borrower and sanctioned from authorities and compliance of terms of sanction. What all documents application has to be made, and if they put some security, it has to be made in favor of the bank, or the title deed should be legit. All the documents have to be there, and you have to check for the credit worthiness. And there exist some limits to give advances even for the branch manager, right? You have to check whether those all sanctions were within the limits and sufficient margin for kind of if you're doing for factoring or like bills, sufficient margin should be kept against securities, and you have to check at regular intervals. And if securities are shares, debentures, the ownership should be transferred in the name of the bank. Ownership should be transferred in the name of the bank, and securities requiring registration should be registered in the name of the bank buildings. In case of goods in possession of bank, they are test checked at the time of receipt. Okay, we should check that they were not abandoned or etc. And the drawing power register should be updated every month, and the account should be kept with both within both the drawing power and sanction limit, and the advances should be reviewed at least once in a year. So these are the internal controls that have to be in place for advances in a bank. This is prior to giving advance. This is like maintaining or reviewing every month or at a regular intervals. What we have to check? We have to check if it's an OD. We have to check whether it's within the limits of drawing power or sanction, and the DP register is updated, and the goods that were in the possession of banks were, you have to test check that about the quantity and all, and if at all its shares and debentures were there transferred in the favor of bank, and the registration also in the name of the bank, and securities have sufficient margin or not, and these advances should be reviewed at least a year. You categorize this, so it is so easy for you to write in an examination. And how do you audit the revenue items? We have done with the balance sheet portion till now, and now we are moving on to the P&L portion. First, we'll see the income side, that's the revenue side, incomes, what all the incomes that the bank could have. The responsibility of the auditor. What the responsibility of auditor is to obtain reasonable assurance on what about income of that relevant period, and there was no unrecorded income. That is, it's complete. RBI advised that if any income that is more than 1% of its total income, that is on gross basis, or 1% of net profit before taxes, or it should be considered as an accrual basis as per AS 9. Mostly all banks also perform the same. All banks do prefer and have accrual basis only. This is not something to concentrate more about it. And if any item is not, if at all, why I have given is this because if at all they ask in an MCQ, you see how much well we practice in MCQs, there was still exists that new MCQ in our examination, right? We need not take chance for that. We have to do 100% effort. Any item is not material, it may be recognized on a receipt basis. You need not qualify report for just for not maintaining a receipt accrual basis. They need not do modify your report. Banks recognize income on accrual basis, like fees or commission, including renegotiations or rescheduling. Yeah, when there is a significant uncertainty on ultimate collection of income, that is, there is a significant uncertainty on collection of income, then what they have to do? They have to recognize when it is realized, mostly like an NPE or losses. Interest on advances may be taken into account as on due date. Okay, on advances has to be taken into account as on due date when sufficient margin is available. That is, they're talking again about the accrual basis. And bills for collection or customer account credited and communication of branch is due only when the bill is actually collected. We're talking about bills here, and it's just not. You need not remember everything like this. It is just a few snippets so that you could recollect it in one day before the examination. You see, first thing is like you need to have a reasonable assurance. That's what. And so for what we have, what's the duty of the auditor? And they're talking about the full completeness of the information. For if we audit anything, we have to check for its completeness. If we audit any kind of asset, we have to check for its valuation criteria and its existence. And this is something for the purely for MCQ purpose. And if it is uh, they're telling more about accrual and receipt basis, mostly we tend to write the correct answer even if we read this few points of 4 to 5 points or not. We know that we have to apportion the commission that we receive for the bill purchase if it falls in between that period is there, right? It have in between 2 years we have to apportion that. That's something common. We have common sense. With common sense we can write are there answers. Still of income. If any advances, including government guarantees also, we have seen it here, right? Like the government guaranteed loans, government guaranteed advances, CG guaranteed advances when the guarantee was not invoked or classified as a standard asset but treated as an NPA for income recognition. So, including those also, including those advances, the entire amount or the entire interest amount that was accrued in past period should be reversed. And we know that it has to be recognized only on realization, that is on receipt basis. With respect to NPS, commission shall also be reversed. That is, expenses in relation to that NPS also have to be reversed because on receipt basis. If any income that is wrongly recognized in past and is either has to be reversed, provision has to be made. Any kind of income that was wrongly recognized, what you have to reverse that income. Inquire large debits of interest income that is not explained, that is unexplained interest income, and appropriate action has to be taken with this regard. Not explained incomes has to be reversed. The component of finance income with respect to leased assets, which are accrued and credited before such asset has been NPA, shall be reversed. Such finance income, that is the interest portion for the leased amount before it is treated as an NPA, that has to be reversed. And take out finance means take out finance is something taking a loan later and is used to replace the initial loan. That's what we have thought of practicing for standardizing the NPA account, right? Taking loan in the same bank and then not repaying the previous loan. That take out finance means taking loan later and is used to replace the initial loan. They are mostly used in property development. That is for regularization of NPAs. This is for property development. If this is like shifting loans from one bank to the another, if it is NPA, then income shall not be recognized unless realized. We know that whether it's takeout finance or something other, if it's an NPA, we should not recognize the income. We have to recognize only on realization. Objectives of takeout finance to expand sources of finance, that is participation of new entries in infrastructure projects, and to boost the availability of long debts for projects. Why long debt for projects? It is for like a sustainable income. Like longer the duration of the loan, more the income, more the interest income that could be get for the banks. If an account turned into NPA, banks may continue to record accrued interest in memorandum account in books of account for control purposes. If an account turned into an NPA, banks may continue to record accrued interest in memorandum account. What we have talked about here, we have to not recognize NPA interest or NPA's fees or commissions, but we could recognize that or take into account or into a memorandum account for what control purposes, for internal control purpose or bank accounting process purpose. But this interest should not be taken into account or should not be put in financial statements. It's just a memorandum account, just a dummy account. Interest on investments includes income from government securities, bonds, debentures, corporates, all the assets that you find in the balance sheet, and which excludes dividends from subsidiary joint venture, whether in or abroad India. Dividends are apportionment of profits because of subsidiary and joint venture, not investments in some other banks, which was not unrelated. So they're talking about interest income and other income here and expenses. This is just a snapshot in your study material. And what all the things, profits on sale of investment should be in P&L account and revaluation of investments in P&L account. And now we are moving on to the audit of expenses. Assess the overall reasonableness of analyzing ratios of interest paid on different deposits and borrowing. That is, they're talking about the percentage of interest that was paid on the loans that were taken by the bank. Interest paid, how do we know that? The formula is interest paid, that is interest expense divided by average deposits equal to average interest rate. That is an average, or total interest paid divided by the average deposits or borrowings equal to, you'll get what? Average interest rate. And as the weighted average interest rate and actual average interest rate, and then compare. This is, they're talking mostly about some substantial procedures. And the auditor understood process of computation of average balance and recompute the sample basis. And auditor should test check basis that interest provided on all deposits up to balance sheet date, that is completeness. And interest rates are as per RBI and banks international regulations, and balance, that is HO balance and RBI balance. And auditor should ascertain changes in interest rate during the period and analyze the completeness on entire borrowing portfolio. That is, he has to, what the auditor is doing is, auditor of expenses is mostly concentrated on interest. They're talking about the completeness of the interest that has to be made for the deposit up to the balance sheet, and they're talking about the interest rates and average interest rate with regards to the weighted interest rate comparison. And they're talking about the inter-branch balances, HO and RBI balances, whether they balance with us or are balance with them. And interest rates as per whether such interest rates were as per RBI and international guidelines, and auditor should ascertain the changes of interest rates also and recompute such interest rates. That is simple with regards to the audit of expenses, mostly with regards to interest they're talking about. And audit of operating expenses. The auditor should evaluate internal controls with respect to expenses, including authorization procedures. That is the limit of authorization of such expenditure. Examine if there are any divergent trends and should perform substantive analytical procedures, or auditor should verify expenses with supporting documents. These are mostly like a procedural thing. What we have to do, how we have to write is that first we have to check about the internal controls. Then we have to check the trends, and the substantive analytical procedures have to be performed. And then obtain evidence, audit evidence with regards to the operating expenses support with supporting documents. And audit of provisions and contingencies. And provisions is like mostly like debtors provisions or contingencies in any kind of legal expenditures, etc. And auditor should ensure that the compliance of various regulatory requirements for provision, and it includes basis for classification, and obtain the detailed breakup of all loans and agree with general ledger, obtain tax provision computation from management, and examine the adequacy of circumstances warranting provisions. Now, what they are talking about is that the auditor should ensure compliance of various regulatory requirements, that is, with regards to provisions. We know that for some standard, it is 15% classes and 100% likewise. So, secured for different percentage, 25, 40, 100, and for secured 100. We have to also check for the classification and that breakup of loans. And circumstances warranting such provisions. It's mostly talking about the provisions requirement only. That is, they have to follow the rules and the basis for their classification and circumstances warranting those provisions, and the detailed breakup of all loans. That is completion of all loans into that classification category. And they're talking about contingencies or to obtain tax provision computation from the management. And that's it. We are done with audit of banks, and all the best. Please do question back, do practice, and practice the MCQs in our Telegram channel. We'll be posting codes daily, so we could practice there, and I'll be happy learning. Please do subscribe and share it with your friends.